that Kristina and I have known each other for a long time through our kids who were friends, and we spent an enormous amount of time on the sidelines of baseball because my son, Zach, and Kristina's son, John, played baseball together from the time they were small, and now they're juniors in high school. Okay, so.
In college.
I could dream in college. In another small world, Kristina was a lawyer at Latham & Watkins when I was at the Carlyle Group. And I started the sustainability practice at Carlyle. And Kristina was working for Latham & Watkins, which was our main outside counsel. And we were talking one day on the sidelines, she said, I want to get into sustainability. And because you were a corporate?
I was a corporate securities
lawyer. Yeah. So I said, okay, well, actually our sustainability group is bringing in all of our chief sustainability officers from all the companies we own. We're having a workshop. Just sneak in. Like, I'll invite you, and that'll be a good way for you to kind of get some exposure to sustainability. And so she did. I don't know if you remember that.
But it was the most amazing thing. I mean, Dave is so generous and so giving, and I've certainly never forgotten that. And I've tried
I didn't know
to
if you forgot that, but I remember.
Well, no, but I mean, as I have the opportunity to help people now, I try to do that. And I learned that in no small measure from Dave, because when I was, even though I'm older than you, I was the junior-ish lawyer, and he, really helped me, and it made a huge difference. And now if I can help other people, I try to.
Okay, well, we have a lot of students to intern with you. And so then Kristina has an undergrad from Duke. She has a law degree from Colorado. She has a master's in sustainability from Yale. And she took this little opportunity and built a career in sustainability. So she's now the chief sustainability officer at Persefoni. She'll talk about that. She was the head of climate disclosure at the SEC under the previous administration, where she wrote the climate disclosure rules, which you all are learning about in your classes. And so when Professor Darnell and Professor Anderson and I were having a brainstorming session about our sustainability program, and I said, I want to bring someone in who can speak about sustainability and AI. And Professor Darnell said, well, let's bring in Kristina Wyatt. And I'm like, done. So thank you for being here.
Thank you.
Kristina also, I admire her because I don't know if she went through a major health scare, and maybe she could talk about perseverance, which is a good thing for us we always talk about that with our students too. And then I think, does everybody know Professor Darnell? So she is our star recruit. She is the first endowed chair in sustainability that Mr. and Mrs. Kogan gave us a boatload of money to be able to hire a fantastic faculty member. We recruited her from Arizona State, where she was the assistant dean for their sustainability school. She was recently named as one of the top 50 sustainability leaders in the world. She was the only academic on that list. And so thank you for being here, and thank you for moderating this discussion. And Kristina, thank you for being here as well.
Thank you. And I'm really pleased to share a seat next to another top 50 sustainability person in the world. We were both on the list.
And I'm honored to be here with you. I've long admired your work, and I'm thrilled to be here with you today.
I can't wait to talk a little more. Our connectivity goes back to ASU, where I was running student teams to work with individuals in Persefoni to help organizations think about decarbonization and how to get a handle on decarbonization. I'm really eager to be able to do the same thing here now that I'm at American University. So I'd just like to kick things off and talk more generally about the industry and the regulatory context, because we're in a strange place right now, but admittedly it's been strange for a while for a variety of reasons. So as you think about the landscape for carbon assessment and decarbonization, tell us a little bit about how it's evolved over the years and what major trends you see shaping the industry?
Sure. Well, going back to my time at Lakeland and Watkins, as Dave was talking about, I had sort of pivoted into sustainability, built the sustainability program there and the ESG practice. And so if we look back about 5 years ago, the landscape was quite different. And some things that we heard over and over again was that there were too many voluntary reporting frameworks. There was this thing that people not so affectionately called the alphabet soup of different reporting standards. It was really fragmented, and our clients were coming to us just saying, tell us what to do. We're getting all these questionnaires from investors, from readers, from, a whole host of different fronts, and they're asking us for slightly different information. And it was really quite difficult for companies. The investor community was also, a lot of our clients were in the investor community, and they were saying, we really need to have some harmonization because we know that these sustainability issues are important to our investments, but we don't have good data and good metrics to try to evaluate that information. And so when President Biden was elected, he made it clear in his first couple of days in office that climate was going to be a big priority. He appointed Allison Heron-Lee, who was an SEC commissioner, to be the acting chair of the SEC. She called me up and asked me to come over and work on the climate rule. And I said, yes. And she said, well, do you want to talk to Latham or talk to your family? And I was like, no, I really want to do this. And she said, well, it could just be until Gary Gensler is confirmed. It might just be for a few months. Are you sure you want to think about it? I was like, no, I thought about it. This is what I want to do. And it was a great opportunity. And it was very clearly following where I thought the world needed to go. We needed to drive greater harmonization in the reporting landscape to make it easier for companies and to make it easier for investors so that we could start to move capital toward climate solutions and to address the risk that was embedded into our financial system by climate change that wasn't really adequately being addressed. So I went over to the SEC. We worked on the climate rule. It finally came out a couple of years ago. And it really, what we did when we were crafting the climate rule was to listen to a whole lot of different stakeholders. We listened to companies, investors, NGOs, standard setters, other regulators, et cetera. But we didn't want to reinvent the wheel. So we ended up using the well-known standards and well-used standards of the Task Force on Climate-Related Financial Disclosures, or TCFD. Have you guys heard of that? Okay. So TCFD is a really good anchoring framework. And then the Greenhouse Gas Protocol, which is the thing that defines Scope 1, 2, and 3 emissions, as our sort of two guiding frameworks to help structure the rule. And while we were doing that, we were also working with the IFRS Foundation, which ended up forming the International Sustainability Standards Board, or the ISSB, and a lot of other jurisdictions around the world to try to drive this common lane of travel. And what came out of that was for the SEC rule and then the ISSB standards, which align quite closely with the SEC rule. There's some differences around the edges, but pretty close alignment. And so now today, the SEC rule, it is in litigation. The SEC has said that it's not going to defend the rule. So that rule is likely to sort of go away. And I've had a lot of people say, oh, too bad, you must feel like you wasted all these years of your life, whatever. And I don't. I mean, that work was good work, and it was, I think, really worthwhile because it helped to drive this alignment around these two standards, the TCFD and the Greenhouse Gas Protocol. And the ISSB standards are now being considered by some 35 plus countries around the world. You have the UK and its Transition Plan Task Force, which again aligns around the ISSB and the Greenhouse Gas Protocol. Even Europe, with its CSRD, its Corporate Sustainability Reporting Directive, is fairly closely aligned to the ISSB on climate disclosures. We have California, which has a couple of laws, SB 253 and SB 261, which again follow that same lane of travel. So we've gone from a really fragmented reporting landscape to one that's much better harmonized now. And that's kind of, I tend to see, I tend to have a glass half full instead of half empty. I mean, that's the positive out of all this, is that I think we are on a path that is better aligned, and that's going to serve the world because we're going to have common metrics to evaluate climate risk and to help investors to allocate capital in a way that recognizes that climate risk. Is that too long?
Not at all. That was fantastic. You really laid out the regulatory context and the conversation, the important harmonization that was needed. I'd like to go a next step.
Sure.
So you talked about the SEC choosing not to litigate. It has stated verbally that it has decided it will not litigate. We've exited the Paris Climate Agreement, so we've seen a lot of change in the last few months. How do you see this affecting organizations' sustainability commitments and commitments to decarbonization moving forward?
I actually think it's such a fascinating time because in some regards, the pressure is off of companies, and for all those companies that want to just sort of ignore climate and renege on their commitments and sort of say, look, this isn't really a thing anymore, I think they have some flexibility to do that. I mean, many of them will have reporting obligations in California or to the ISSB, but they sort of say, look, we just don't want to commit many resources to addressing the transition to a lower carbon economy. I think there's space for them to do that. And equally, there's space for the companies that really want to lean in, that look down the road and say, climate change, unfortunately, isn't going away. And, we can have our political shifts and twos and fro's, but the fact of the matter is that climate change is going to continue to represent financial risk for companies and for our economy and for people into the future. And so I think this is an unusual time where companies that can smartly allocate resources, so find ways to allocate resources in a way that still promises future returns and enables them to find ways to decarbonize, to operate in a lower carbon fashion and wherever they sit in the value chain, will stand to reap real rewards and real benefits in the future. So it's a little bit different than when climate change was all the rage and everybody was rushing into it, and it was hard to distinguish between companies who were sort of taking action on climate change. This is now a time where some are going to lag behind, some are going to try to find that middle, and some are really going to try to lead and find ways that are economically viable, but that set them up for long-term success in a world where we are actually addressing climate change again.
I'd really like to bring now Persefoni into the conversation and its approach to thinking about this space and the innovations that it's drawing on in order to help solve some of these problems. So we know that Scope 3 emissions account for between 92 and 96% of an organization's total carbon footprint. So if an organization is serious about climate, they need to be thinking about Scope 3 emissions, which are really those supply chain emissions, procurement emissions, but also how the end users engage with their products and the like. How is Persefoni helping tackle this issue of Scope 3 emissions? Because it's a juggernaut for many companies to really think about the complexity of how they engage their supply chain to figure out what their total carbon footprint is, because if you don't measure it, you're not going to manage it. How is Persefoni helping me here?
Well, I should say, first of all, that I came to Persefoni after the SEC. I had a one-year assignment at the SEC, and then I thought I would go back to Latham. And I came to Persefoni because it was fairly clear that we were writing rules that needed to be written, that it was important for companies to report on their greenhouse gas emissions and their climate-related financial risks, but it was also hard for them to do so. And so I came to Persefoni because I wanted to work for a company that was making it easier for companies to be able to calculate their emissions in a way that was less costly and give them more reliable and useful data. So we're a SaaS or a software as a service company. We sit in the cloud and we're AI powered. And our whole reason for being is to make it easier for companies to be able to calculate their emissions. So basically to take all those activities that they engage in and translate those activities using the greenhouse gas protocol into their scope 1, 2, and 3 emissions. And that involves a lot of matching up of, say, hundreds of thousands of activities with hundreds of thousands of emission factors and getting that matching up right and rolling out properly into your scope 1, 2, and 3 emissions. And then that's a fairly simplistic view of it, but then, being able to break it down to understand where your greatest sources of emissions are and where your opportunities for reduction are. We use AI to do things like, say, take your spend data. So if we have a company's general ledger and it's spending money, all these vendors on all these different things, we can take that data and use AI to discern what emissions are likely associated with that spend. So figuring out whether it's scope 3 category 1, purchase goods and services, or something else, and then helping to identify the appropriate emission factors that go along with that spend. So that's one way that our AI helps with calculating your scope 3. We also work with our customers to try to take a fairly practical approach. So we talk frequently about crawl, walk, run. A lot of customers will come to us and they just want to get the most granular data that they can at the outset, and that's usually not very practical. And if you think about sort of Pareto optimization, it's not really the best use of their resources. So in the first instance, we usually help them to get a high-level view of their scope 3 emissions. So if we're talking about category 1, purchase goods and services, it might just be spend-based data where you're not going to your actual suppliers to get actual reported data in the first instance. But maybe after you get that first high-level overview, you can start to see these are our pockets of greatest carbon intensity. And these are the vendors that we perhaps stand to influence the most. And you can sort of triangulate on a strategy to figure out, well, which vendors do we really want to go to try to get more granular data from them. It's not rocket science, but it's a tool that can help companies to think in a more practical way about how to get this data and then how to make decisions that can help to lead to decarbonization in their supply chain. We also have a free tool that we offer up to anybody who wants to go to our website that can enable smaller suppliers to enter their activity data and then derive emissions data in a way that's more accurate, aligned with the greenhouse gas protocol, and essentially provides a better estimate of actual emissions than some of the free carbon tools that are out there.
Right. So there are other tools that are out there. Help me understand what Persefoni's secret sauce is in this conversation. What makes it special amongst the sea of other companies that are out there trying to do the same thing?
So we are really committed to building really good software that can help companies to understand their emissions. And we have a lot of people who are really smart who help support that, and we work with our customers, but we want to give our customers the software so that they can enter their activity data whenever they want to, on whatever cadence, and really use it themselves. They want our support. We're there. All the other companies that are out there sort of say they're software tools, but they're really sort of like consulting firms that are maybe software enabled on the back end. So
behind a paywall of sorts.
Yeah,
as
exactly.
you engage with the software itself.
Yeah, and so you might you won't tend to have the ability to actually work with the software to move levers and see how your decisions may impact your carbon emissions, and also to see that in real time. So frequently, some of the other tools that are out there will sort of take bunches of your data and then take it away for a couple of weeks and then give you a footprint, which is fine if you just want to have a footprint to report. But if you want to have a tool that can help you to make decisions around where you might want to decarbonize and what might make financial sense, then having a tool that's really in your oin hands makes the most sense.
We've talked about this a lot, but we've never gotten into the nitty-gritty of some of this. And as you're talking, it causes me to think that what you're doing is you're enabling real-time learning.
Yeah.
That otherwise wouldn't exist. It's a wait and see thing, and then you get a company is dumped with whatever message is delivered by another consultant, but that real-time learning isn't taking place.
Yeah, and it's happening. It's a really good point. And it's happening at the personal level with our customers, but it's also happening in the platform. So to be clear, the data that's entered are our customers' data. They own that data. But of course, we anonymize that data and learn from it, right? So as customers derive decarbonization levers that are economically viable, right, that are net present value positive when they run the cost analysis on it, we can learn from that and incorporate that into our library of decarbonization levers. So we're learning and our customers are learning.
I'm wondering if you can share an example of an organization that you've worked with where this has helped them realign their strategy.
Yeah, I mean, we work with organizations sort of across the economy. So, from manufacturers to retailers to private equity firms, the gamut. One that I really like is a very large food service company, and they use us to help to track their scope 1, 2, and 3 emissions. And one of the big sources of emissions for them is food waste. And so we've been able to help them to measure their food waste and to understand where their offerings, whether their menu offerings might be modified to reduce the food waste, but also to reduce the carbon intensity of the food that they offer and the food waste. So as a general rule, for example, food that has more legs tends to be more carbon intensive, and they don't try to, they take their customers as they find them, and some of their customers want to eat meat, and that's fine, it's great. But they've made some changes around things like moving the meat to the end of the buffet aisle so that people fill up more with vegetables, et cetera, reducing the amount of waste in pre-production and that sort of thing. So they've actually been able to reduce their costs and reduce the carbon intensity of the services that they offer. And that's been really beneficial to them in working with their customers who had their own carbon reduction goals.
Thanks. When we think about decarbonization and the opportunities ahead, I imagine there are a lot of misconceptions among organizations about where to start, how to get started. At the heart of any sustainability initiative within an organization, you're managing change.
Yeah.
So what are some of the biggest misconceptions or hurdles that you've had to encounter as you engage with companies or organizations more broadly in thinking about decarbonization?
Yeah, I mean, I think that one of the things that's really hard is that we're trying to address risk that hasn't necessarily yet manifested into the future. So we're making assumptions about, we know certain things, like the science is pretty clear as to where the planet is going. And we see around us that there are physical manifestations of climate change that are heard to be far. And we can see the projections as to how those are likely to increase. And we can imagine things like, as companies and individuals are unable to procure insurance on their properties, that we're going to see more defaults, and that's going to have a real impact on the financial sector. But I think that we're still sort of nascent in terms of really being able to anticipate where the world is going and what those financial effects are going to be. And I think there's still a lot of opportunity to do good work there. And I think that a lot of companies think that just because there's uncertainty about future risk, that they can discount it as if it's not going to happen, where in point of fact, in order to build a resilient business, pays to think about that future risk, incorporate that uncertainty, and think about it just like any other risk, where you evaluate the probability of the thing happening, the magnitude of the harm if it does happen, and then building plans, strategies to address those risks. Climate is no different. It's just a little bit complicated by the fact that we have this regulatory system that's sort of up and down. We have consumer demands that seem to be going in a direction, but they're also a little bit up and down. Same thing with financial institutions, where a few years ago, I think there was more pressure on companies to show decarbonization. And now the financial institutions are sort of pulling back on their commitment. So it's not a straight line, but I do think in terms of those sources of what we call transition risk, right? So transition risk being the risks that companies face as we transition to a lower carbon economy. All of those things, customer demands, regulatory changes, litigation, potential carbon taxes, all these things are very real, but they're a little bit uncertain.
Yeah.
And I think we tend to over discount them because of the uncertainty, where I think smart companies are finding ways to actually address those risks, not necessarily in a way that's, financially ruinous in the short term. I mean, they're finding creative ways to build a decarbonization pathway that makes financial sense in the short, medium, and long term.
There's, within this risk bucket, it's really big. You've spoken about a lot of different items. There's another type of risk that is in the back of my mind that relates to measurement and the wait and see to ensure, because no measurement technique that we have right now is perfect. Right?
Yeah.
And in talking with the different organizations that have entered my orbit that are interested in managing Scope 3, one of the biggest justifications I hear, even for the sustainability savvy companies, is that, we're going to wait and see until we're going to wait for the measures to get better, because they're not where we feel comfortable now. How would you respond to one of those companies?
Yeah, I mean, I think it's a convenient way to create an excuse to, for inaction. And I think that exposes companies to risk. I mean, it's one of the ways that companies are excusing their own sort of stepping back on their commitments, or deciding not to invest the time and resources necessary to actually measure their emissions and build a plan to decarbonize. The measurement tools are there. I mean, Persefoni is one, and there are others. And there are others on the physical climate side as well, which is critically important. I mean, if you have operations or important parts of your supply chain that are in low-lying areas, or areas that are at risk of damage due to hurricanes or wildfires or whatever, it's just risk management to factor those things into your risk analysis and strategy. The data are getting better, and I think that the companies that calculate their own emissions and use the tools that are available, maybe not to get again to the Pareto optimization, maybe not get the most granular data down to the million supplier, but to really try to build a picture of where they have that transition risk and ways that they can mitigate it will empower them to be able to take those actions to reduce that risk, and also empower them to tell their own story, right? Because part of the problem that we had 5 years ago was that the raters and rankers were telling the story for the companies, because they were, issuing all these questionnaires and then giving these different ratings and rankings, and companies didn't like that. Well, companies can't tell their own story if they don't have good data. And this may come out in voluntary disclosures. It also may come out as a result of litigation that may come down the pike, or other challenges that are kind of reasonably foreseeable.
Yeah, this is really great. I have one last question, and then I want to open it up to you all and to our online community. So what advice do you have for graduate students and faculty who are interested in contributing to the field of corporate sustainability? whether through research or practice, what opportunities in your space do you see on the horizon, questions that are not being asked and answered that would really help the practice?
Yeah, I mean, I think there are so many opportunities that really manifest, and there's a lot of good work that's being done, just not enough. I think on the science side, we need to deal with the energy transition. I'm not so naive as to think that we shouldn't be pumping oil out of the ground and using it, because we need to operate our societies. The idea that we're just going to get people to stop doing the things that they're doing is unrealistic, but that's also not the end game. There needs to be a transition that, regardless of our president and what he thinks about renewable energy will be a part of it. But working on the science of things like storage and increasing the efficiency and capacity of renewable energy, I think that small modular reactors, nuclear, needs to be a part of the equation as well. I think we need to open our minds to all of the solutions that we're going to need to drive to a lower carbon economy. That's sort of on the energy space. I think on that materials space, there's going to be a lot of opportunity in driving circularity and reducing waste and reusing products. And so there's a lot of sort of green chemistry that's very interesting. On the finance side, as I was talking about, I think we don't yet do a great job of really linking our financial analyses to our decarbonization efforts and really thinking about, well, what are those risks over the short, medium, and long term that relate to climate change? How do we put a value on those? What are our levers that might be available to us to mitigate those risks? And then how do we do that net present value analysis to determine whether this is a good investment or not? So what interest rate do we want to apply? I just don't see a lot of that really rigorous financial analysis being done that ought to be done and can be done and is just going to be critically necessary as we go into, from now on. And depending on where you want to go, certainly on the policy front, our country is allergic to the idea of taxation, but we will have a carbon tax at some point because we'll have to, whether it's called a charge and a rebate or something else. So on the policy front, I think having really smart people who can understand the economics and, sort of the how to move the needle probably within the Department of Treasury or, I think there'll be lots of opportunity there. So yeah, lots of opportunity. And I think that, being in a business school that's so focused on sustainability is a great place to start, because we don't need tree huggers. We don't need people who just want to go out and rally. We need people who can apply business analysis to help companies to be more resilient and to thrive and to apply that economic and financial analysis to potential solutions so that they can win in the future.
That's great. All right. There's a lot of fodder for conversation. Questions? Please, you.
Kristina, thank you for being with us. My name's also Kristina, and I'm a junior in the Co-Pilot Honors program. I would love to know your thoughts on AI's environmental impact. I've seen a lot of things online. Granted, I'll be super transparent. I haven't super fact-checked them myself, but there's been a lot of information circulating talking about how AI and the mass use of AI could be really bad for our environment. And so I would love to know your thoughts on that. And if so, what should these AI companies be doing to ensure that we have a sustainable future as AI becomes more growingly popular? And it seems to be our future. So you look at a lot of users. So
yeah, it's a great question, Kristina. So that gets to the point that I don't think there's any avoiding the fact that our energy consumption is going to be increasing. We're seeing that. We're not going to get there by just trying to reduce energy consumption. And so, and I think AI is our future. We're going to increasingly use AI, and I don't see ways to do that without a lot of energy consumption, which sort of gets back to we need all the energy solutions that we can find, which starts now with a combination of fossil fuels, hopefully not coal, but, oil and gas, natural gas, and renewables. Renewables are great, but we have storage problems, which gets me to small modular reactors, so nuclear, which are, my 20-year-old self would have said, no way, no how, right? But I don't think we really have the luxury of sort of hoping for the ideal. Obviously, with nuclear, we'll have to think about what to do with the nuclear waste, et cetera. But I think there's a lot of potential there because we haven't innovated in nuclear in a very long time in this country. And so there's a lot of opportunity to bring down costs and standardize the production of these small reactors. And, it may not seem like the absolute ideal, but I think it is probably a necessary path that we'll have to take. Thank you.
Other questions?
Yeah, thank you, Kristin. Thank you for sharing a lot of the details about your work. So I think it's really exciting you work in the intersection between sustainability and the AI. So Nicole just said what has matters was get managed. So as an accounting professor, I cannot agree with more. So what I'm interested is that you talk about now can you use AI to measure the this kind of the scope 1, scope 2, scope 3 emissions, right? So I think what will be interested for our students is that, so what do you see, what kind of the part now is kind of fully can be automated by AI? So what kind of job will still be augmented, right? So will be kind of the human and AI work together to kind of contribute in this space. I would have to give you
such a great question. And I love that your school is so committed to AI. Because it is the future, and I can't imagine very many jobs that won't be impacted by it. So, I think as to carbon accounting and decarbonization, AI is going to really, in the next couple of years, play a huge role in just creating transparency and finding solutions, which, back to the point about companies that want to just sort of do the minimum versus those that really want to lead, I think the transparency that's going to be driven by AI is going to make it so that you can't really hide. So these things that are currently kind of economic externalities are going to be internalized by the transparency that's created by AI tools. As far as how your students think about entering a world where AI is so dominant, I think I'd love to turn the question back to you and ask how you think about that, because I think it should empower people, and there's still, so much that we as humans can bring to the equation so that ideally AI can give us access to information, but we still have all the things that humans have that AI doesn't. So our ability to form connections with each other, to support each other, to have empathy, to craft a story that's authentic. I mean, AI can do some of that, but I think there will be a piece about how humans choose to use the AI to sort of optimize what they're trying to do. But tell me, what do you think?
So so let's circle back to an article shared by one of my colleagues, right? So share that article with us that in terms of operational budgeting. So these are an AI now the article said it can do most of it already. So if you know the goals, right? So but in terms of the strategics, right? So if the goals are not very clear, or you have conflicting goals. So it looks like there's still AI cannot give you the most optimal findings. So I'm thinking then in this, so my thought, the very preliminary, so then like you said, right? So telling the story, so setting the goals, taking the strategic goals, right? So how to balance the different impacts, right? Financial, I guess human beings, hopefully we can still contribute a lot. So yeah, very proud of yourself.
Yeah, I think it's a great question. And my hope is that AI enables us not to be so sort of down in the weeds developing facts and information, because the AI can do a lot of that, but helps us to lift up and think strategically about what to do with that information. But this is all pretty new. I mean, I guess we'll see. It's a great question. I still I still believe humans are important.
One of the things that Mike Wallace, your chief decarbonization officer at Persefoni, a term he uses that I love every time he says it, is that this is about data democracy.
Mm-hmm. Yeah.
The transparency is real. It's helping individuals make better decisions by virtue of making the data public and more widely available.
Yeah, absolutely. And I mean, back to when I was at Latham, before the SEC rule was written, a lot of that was actually driven by this idea of data democracy and the unequal access to climate-related data, because the data shows that the raters and rankers were charging hundreds of thousands of dollars to large investors for this climate-related and other ESG data. So, it's hard to imagine that these investors would pay that much money if they didn't consider it to be material information and incorporate it into their financial models. And yet that information wasn't widely available to everyone. So the companies that were so small that they couldn't afford to respond to the raters and rankers were sort of on another level. And then the investors who couldn't afford to pay for all of this research were on another level. And a fundamental premise of the SEC is that the markets can only operate efficiently if we all have equal access to material information, that the markets will come to an appropriate price for securities that are trading if we have equal access to information. And it was that inequality that we're trying to address. And I do think that the rules, the ISSB standards, this direction of travel that we're on, that creates kind of that level playing field, plus the AI that's just increasing the actual transparency of the data, will help with, providing that sort of democratization.
That's great. Other questions? Wait, a few more minutes.
Go ahead. Real nice.
Sophia and then
I'm Sophia. So I wanted to know a little bit more about what you're seeing in the future of the frameworks that are going on. Like you said before, there's an alphabet soup out there. And 10 years ago, there was a lot of, hurrah, let's all do this, blah, blah, blah. Now, especially with our administration, we're seeing a lot of green hushing from companies. Are not really talking about what they're doing, where they only talk about certain things, not about others. What are you seeing? Where are you seeing that go? Do you think in the future, maybe with another administration, or even within this current one, are we going to see an even further quiet of how people are reporting, companies are reporting, or in the future, was it going to go back up where everybody's going to shout to the rooftop?
Yeah, that's a great question. I mean, I think there's still a drive to report, and that is, I think, propelled by California, which has its climate disclosure rules, SB 253 and 261, which will basically disclose your greenhouse gas emissions and disclose your climate-related financial risks and what you're doing about them. They're going to apply to some 5,500 companies, more or less, would be more. Europe still has its corporate sustainability reporting directive. They're undergoing an analysis now in what's called the omnibus, which is evaluating pulling back some of the requirements. But climate is not going to be pulled back. It's more a question of sort of when that disclosure will be required and some of the details around assurance, et cetera. The ISSB standards are going full steam ahead, and there are some 35 countries, 35 plus, that are evaluating the ISSB standards to incorporate into their rules. So I think there's going to continue to be reporting. Be really interesting to see what companies do when they're SEC filings without an SEC rule. I think there's going to be a lot of hedging and, probably some more risk factor type disclosures, but not as robust as what they'll see for California or the ISSB. So yeah, I think there will be some green hushing, but still a lot of activity behind the scenes. The other area where I think, we you have manifest kind of green hushing is in DE&I, where, I think companies are just trying to figure out, how do I stay on the right side of this thing? Because there's no right side, so it's like you can't discriminate against anyone. And how do you document that? So I think that's an area where companies are just saying as little as they possibly can, and then just trying to figure out within their companies how to document that they haven't discriminated against anyone.
That actually is a good pivot. First of all, thank you, Brandon. Thank you. Good stuff, Tony. I wanted to ask you, using your SAC lawyer and hat line, what do companies do in their upcoming filings? Because some companies have said in their disclosures, which are part of like a commitment to shareholders, we're all in on this, or here's our approach. And now you have an administration that is hostile to that, but they have shareholder obligations conflicting with administration policies. And so what do you expect? And how do you expect firms to handle that?
Yeah, it's a great question. We're getting a lot of questions about that these days, particularly as last week the SEC said that it's not going to be defending against the litigation that's been filed against it related to its rules. So basically there isn't an SEC rule, and yet companies that have made these commitments, they're going to be reporting in California, they're going to be reporting presumably to the ISSB. And so a lot of companies are saying, well, how do we reconcile these things? I think some companies are going to just pull back from their broad commitments and say, look, we've seen this with the financial institutions who have said, look, our net zero commitments with regard to our finance emissions, the emissions associated with the things that we're financing, are proving to be unrealistic because the rest of the economy isn't decarbonizing fast enough. So they're pulling back with an explanation. A lot of the questions that we're getting are related to, well, if you make a determination that these climate-related risks are material for purposes of your California or ISSB reporting, what does that mean for your SEC reporting? Nobody really wants to put more information in their SEC filings than they have to, because they carry some additional potential litigation risk. So how do you square those two things? And so there's guidance that the SEC put out in 2010 that basically relates to climate. And it says, if you have material climate risks, then consider under our existing rules whether you should be discussing them in your risk factors, in your business description, in your MD&A, in your financial statements. And I think companies are going to go back to that and probably see more risk factor disclosure. And then they're going to couch their disclosures to California in a way that tries to distinguish their SEC disclosures to say, these are the things that we believe are material climate risks, but like lowercase m material under the T. It's going to be a lot of splitting of hairs. And I think a lot of lawyers are going to be spending a lot of time on this. It's not a very good answer, but, I think they're also going to be, using the safe harbor and the Securities Litigation Reform Act and kind of couching their disclosures carefully. At the end of the day, also, companies need to be aware that they face securities law litigation risk, even for information that they disclose outside of their SEC filings. So, I think some companies think, oh, I don't have to do anything in my SEC filing now, but I'm going to disclose all this stuff to California and the ISSB. Well, it's a little more complicated than that. They really have to think about the veracity and whether they can back up the statements that they're making, even outside of their securities law filings, because they can be sued for those. We're under anti-fraud provisions. So, it's complicated. I mean, I think we're going to see some more kind of weak disclosure in the SEC filings and a lot of couch disclosure outside of the filings. And we'll see litigation around those disclosures and around inconsistencies between the two.
Yeah, follow on to that, if that's okay. So I think it's interesting to think about, obviously the regulatory environment is sort of, you're forcing something onto a company, right, that they may or may not want. So but then there's the practical side of it, right? So I own a small business. It's located in Maryland. PJM is the regional distributor of electricity, right? Not the supplier, but the road that the electricity passes on. And those rates are going to go up in June by 810%. So that's going to translate into a roughly 30% increase in every business's utility cost,
Yeah.
right? So that's a different kind of thing, right? Because on the regulatory side, you're sort of being forced and you're trying to figure out, I don't want to spend additional money that other businesses aren't spending because it makes me anti-competitive. However, there's an entire side of the market that's just being driven by good business, right?
Absolutely.
So you can address your supply chain issues in order to bring those costs down simply because you know that you have costs going up related to AI, data centers and things like that in other places, which make it almost, you may not want to disclose, you may want to greenwash like what it is from a political perspective, but from a practical operational perspective, I feel like businesses are sort of talking out of both sides. They don't want to be forced, but they're also not going to do it, right? Because at the end of the day, it's an economic issue.
Yeah.
And as long as it's economic, it makes business sense.
Yeah, absolutely. And I think that's where ultimately we need to be, is thinking about what are the business implications. For as long as this is just sort of a reporting exercise, it's not particularly valuable, right? But when it becomes a real business, and this is sort of why I was dwelling on the importance of really incorporating climate risk into your financial analysis, it's a perfect example. You know, how does this actually manifest and what are the impacts for my business and how do I mitigate for its risks? And that's, it's critically important that this not just be a check the box kind of, compliance exercise.
I just offer one other comment. This is more for the students.
You have the last word, Dean.
Okay. So one of the things that I think the students can learn, if you all stay after the entire says and can learn from Kristina, is just to fake it and pretend you know it. Okay, so going back to this conversation, she was a lawyer, a corporate lawyer at a big firm where she was great, but you kind of get pigeons, pigeonholed. This is your role. Okay. And I remember the conversation, she said, I really want to do sustainability. I said, come to this meeting of sustainability experts and just pretend like you know what you're talking about. Okay. And she did. She just showed up. In the period, this must have been 2000 and
The 2000,
2000,
I think 2020, 2019, 2018.
much older than that.
Yeah, 2016. I don't know.
Okay. In a very short period of time, call it 10 years,
Yeah.
she's gone from really not knowing anything about sustainability to becoming one of the world's experts and leaders in this space. And so the lesson there for students is just fake it. Just lean in. You can do anything. You can pivot. And just try it and don't let anybody say.
Take the risk.
Take
It's
the
worth
risk.
it.
Take the
Yeah.
risk.
The other thing that I would just add on to that is that, being friendly to the people that are on the sidelines with you is really good, right? And but also I met Allison Harrell-Lee, who was the SEC commissioner who became the acting chair. I met her because I sent her fan mail on LinkedIn. Literally, I sent her a note, and I had worked at the SEC before for a commissioner who was in the minority during a really rough time. And I just sent her a note saying, I know that it's lonely out there and really appreciate the work that you're doing. But she was just getting beaten up because she was talking about climate and ESG issues. And so she called me, and we struck up a friendship, and I ended up bringing, major Fortune 50 clients to her to talk to her just to give her a sense of the lay of the land. And then when she became acting chair, she called me up and said, why don't you come over and do this? I was like, yeah. So wow. I think it's, don't be afraid to ask people, just
And to
connect
be
with people.
kind and reach out. And even if you're not offering assistance, just support.
Get right.
That's impressive.
And mostly be like Dave. Be like, just watch.
Well, with that, I want to thank you.
Thank you.
This
Thank
was
you so much for
terrific.
having me.
You've been so generous with your time, and
I'm so honored to be here. Thank you so much. And thank you for the great questions.
Thank you.